there, and welcome to the Property Wealth Podcast. We're so glad you're joining us today. If you've ever felt overwhelmed by the idea of getting into real estate investing, you're not alone.
Absolutely, Sarah. And today, we're diving into a topic that might just change the game for you. DSCR loans, which stands for Debt Service Coverage Ratio.
Right. And what's really interesting about these loans is that they don't require income verification. So if you've been worried about your financial situation, this could be a great opportunity to consider.
Exactly. We'll break down what DSCR loans are, how they work, and why they might be a smart choice for investors, especially those of us over 40, looking to build long-term wealth.
And we'll also touch on some practical tips for navigating the lending process and what to keep in mind when considering this type of financing.
Plus, we'll share some real-life examples to help you visualize how these loans can fit into your investing strategy.
So whether you're just starting out or looking to expand your portfolio, stick around. It's going to be an enlightening conversation.
Let's get into it. You know, Sarah, when we talk about DSCR loans, it really becomes clear why it matters, especially for folks over 40. The financial landscape is changing so rapidly these days, and many people are feeling that pressure to prepare for retirement, right?
Absolutely, Mike. It's like there's this ticking clock for a lot of people. They want to make sure they have enough saved up to enjoy their golden years, and not just scrape by.
Exactly. And with inflation being what it is, it's crucial to find ways to preserve wealth. Real estate has historically been a solid hedge against inflation. Property values tend to rise over time, and rental incomes can keep pace with inflation too.
Right, and that's where DSCR loans come into play. They provide this opportunity to invest in real estate without the usual income verification stress that can stop people in their tracks. So for someone who might be nearing retirement or has a side gig, it opens up doors.
I've seen it firsthand, actually. One of my clients, let's call him John, was in his late 50s. He was worried about his retirement savings, but he had some equity in his home. Instead of cashing out and losing that asset, he used a DSCR loan to purchase a rental property.
That's smart. So he didn't have to prove his income for the loan?
Exactly. All he had to do was show that the rental income from the new property would cover the mortgage payments. So he was able to leverage his existing equity without the stress of income verification.
And that must have given him a lot of peace of mind, knowing he was building wealth, right?
For sure. John told me he felt like he was finally taking control of his financial future, and the rental income has been a boost, helping him to feel more secure. It's that emotional side of financial security that can't be overlooked.
I think that's so important. Many people don't realize how much emotional weight financial stress can carry, especially for those over 40 who may feel the pressure to provide for their families and prepare for retirement.
Absolutely. And then there's the aspect of wealth transfer. Many people want to leave something for their kids, right? Real estate can be a fantastic way to build that legacy.
Right. It's like planting a tree that will grow over the years. And when you have a rental property, it not only provides income, but also appreciates in value, which can be passed down.
Exactly. Another client of mine, let's call her Lisa, she used a DSCR loan to buy a two-family home. She lives in one unit and rents the other, and she's already seeing the value of her property increase.
So she's not just securing her financial future, but also creating an asset that her children can benefit from later?
Yes, and she's also generating a steady stream of income, which is crucial as she approaches retirement. You know, it's about creating those multiple streams of income.
And that's so important in today's economic climate. With market shifts happening all the time, relying solely on traditional retirement savings can feel risky.
Exactly. It's about diversifying your income streams, and real estate can be a big part of that. Besides, many people over 40 have the life experience to make informed decisions in this space.
Right. They've been through market ups and downs. They understand risk and reward. It's about using that wisdom to their advantage.
And let's not forget the current economic trends. Interest rates fluctuate, and while they might be high right now, if you can find a property that generates enough income, a DSCR loan can still be a good option.
That's a great point. It's like finding opportunities where others may see obstacles. It's a mindset shift.
Yeah, and I think that's crucial. So many people get caught up in fear rather than focusing on potential. For example, I had a conversation with a woman named Karen. She was hesitant to invest in real estate because of the market uncertainty.
It's understandable, though. The news can be quite daunting.
Absolutely. But when we looked at the numbers together, her potential rental income far outweighed her concerns. We discussed how DSCR loans could help her get started without the usual hurdles.
And did she go for it?
She did. And now she's not only earning rental income, but also feeling empowered. It's like she found a new purpose. That's the kind of transformation I love to see.
That's incredible, Mike. It really shows how investing in real estate can be a lifeline for those looking to build their future. And it doesn't have to be this overwhelming process.
Exactly. It's about taking those small, manageable steps. And for people over 40, it can be a way to secure not just their financial future, but also their emotional well-being.
And that's key, right? Feeling secure and knowing you've got something to pass on. It's about building a legacy, not just for yourself, but for your family.
Well said, Sarah. And as we dive into some core strategies, it's essential to remember that investing in real estate isn't just about the numbers. It's about the life you want to lead and the impact you want to have on those you love.
Exactly. Let's explore those strategies.
So let's dive into the core strategies and rules of thumb when it comes to using DSCR loans, right? These loans can be a game changer, especially for people over 40 looking to build their investment portfolio without the traditional income verification.
Absolutely, Mike. So when we talk about DSCR loans, the first thing we should mention is the debt service coverage ratio itself. It's basically a measure of the cash flow available to pay your debt obligations.
Exactly. And a common rule of thumb is that lenders typically look for a DSCR of at least 1.25. That means for every dollar of debt, you should ideally have $1.25 in income from the property.
Right, so if you're looking at a property that costs, let's say, $1.200 a month in mortgage payments, you should be aiming for at least $1.500 a month in rental income.
Yep, and that's crucial when evaluating potential properties. If a property doesn't meet that ratio, it might not be worth pursuing, you know?
For sure, and then there's the 1% rule too. This is a classic guideline that says your monthly rent should be about 1% of your purchase price. So if you buy a property for $200,000, you should aim for around $2,000 in monthly rent.
That's a solid benchmark. But remember, it's not a hard and fast rule. Markets can vary, and sometimes you might find properties that don't meet that, but still work well for you in the long run.
Right, like maybe you're in an area with high appreciation potential. It might be worth accepting a lower rental yield now if you think the property value will increase significantly.
Exactly. And speaking of appreciation, it's important to consider the market dynamics where you're investing. Look at things like job growth, population growth, and infrastructure developments. Those factors can have a huge impact on property values and rental demand.
Definitely. And when it comes to financing options, DSCR loans are attractive because they often require less documentation. But it's also crucial to understand the interest rates can sometimes be higher than traditional loans because of the added risk.
That's a great point. You might find that DSCR loans come with slightly higher interest rates, but if the property is cash flowing well, it can still make sense. And always shop around for the best rates.
So true. And let's touch on property types too. Multifamily properties are often a favorite for DSCR loans because they can provide multiple streams of income.
Yes! A duplex or triplex can be a fantastic way to diversify your income. Plus, with multiple tenants, you'll have less risk of total vacancy.
Exactly. And for someone just starting, it can be a good way to get your feet wet in real estate investing without diving into a massive single-family home or commercial property right away.
And don't forget about the importance of location. Investing in an emerging neighborhood can be a smart move. You might find properties that are undervalued, and as the area develops, you could see significant upside.
That's where doing your homework pays off, right? Look for areas with new businesses opening up, schools being built, or transportation improvements.
Absolutely. And when evaluating deals, create a checklist. Consider factors like purchase price, estimated rental income, neighborhood trends, property condition, and potential expenses, like repairs and management fees.
Yeah, it can be overwhelming, but that checklist will keep you organized. And make sure to factor in the 50% rule for expenses. Essentially, You should assume that about 50% of your rental income will go towards operating expenses.
Right, so if you're bringing in $2,000 a month in rent, you should budget about $1,000 for expenses. This includes maintenance, vacancies, property management, and all that good stuff.
And speaking of budgeting, it's crucial to have a buffer for unexpected costs. Real estate can be unpredictable, and having a reserve fund can save you a lot of headaches down the line.
Exactly. Always plan for the unexpected. It's better to be safe than sorry, especially when you're investing in properties that need repairs or renovations.
So true. And then there's the importance of cash flow analysis. You really want to ensure that your properties are not only covering the mortgage, but also generating positive cash flow.
Yeah, that's key. A lot of investors get caught up in appreciation and forget about cash flow. It's great if your property is worth more in 5 years, but if you're losing money every month, that's a problem.
Right, so run the numbers before you buy. And remember to factor in potential rent increases over time, especially in growing markets.
Definitely. And while we're on the topic of numbers, consider your exit strategy too. Whether you want to hold long-term, flip, or even refinance later, knowing your end goal will help you make better investment decisions.
That's so important. And don't shy away from seeking advice or mentorship from seasoned investors. They can provide insights that textbooks just can't teach you.
For sure. And now, before we wrap up this section, let's transition to some common pitfalls. There are definitely things to watch out for when you're diving into DSCR loans and real estate investing in general.
Great idea. It's always helpful to learn from the mistakes of others, right? What do you think is the biggest pitfall?
One of the biggest is underestimating the costs involved. Many new investors focus solely on the purchase price and rental income, overlooking things like maintenance, property taxes, insurance, and management fees.
Yes, that can catch you off guard. It's crucial to have a comprehensive view of all expenses to avoid financial strain.
Exactly. And another common mistake is not doing enough due diligence on the property and the market. You really need to know what you're getting into.
Right, and that includes understanding the local rental laws and regulations. It can save you a lot of headaches in the long run.
And, of course, don't rush into a deal just for the sake of investing. It's better to wait for the right opportunity than to make a decision you'll regret later.
Absolutely. Patience is key in real estate investing.
Well, it's a marathon, not a sprint, right? You know, Sarah, one of the biggest mistakes I see investors make with DSCR loans is over-leveraging. They get so excited about the potential cash flow that they stretch their finances too thin.
Right, it's like they see the numbers and think, I can handle this. But then reality hits, and they realize their monthly expenses are way higher than expected.
Exactly. I had a client once. Let's call him Tom. He bought 3 properties within a year using DSCR loans. The cash flow looked great on paper, but he didn't account for the maintenance costs, property management fees, and, well, life happens, right?
Oh, definitely. It's like when you're budgeting for a vacation and forget to add in meals or souvenirs. So what happened with Tom?
He got overwhelmed. The properties had unexpected repairs. One had a leaky roof, another needed a new HVAC system, and suddenly he was in a tight spot. He didn't have enough reserves to cover those costs, and it became a real struggle for him.
That's tough to hear. It's a reminder that cash flow isn't just about the rent coming in, but also about what you're spending.
Right. And that leads us to bad tenants, which is another common pitfall. You know, when investors are so eager to fill a vacancy that they skip the thorough screening process.
Yeah, it's tempting to think, I just need anyone in there. But that can backfire, can it?
Absolutely. I had another client. Let's call her Lisa. She rushed to get someone into her rental because it had been empty for a couple of months. She didn't check references thoroughly, and, well, it turned out her new tenant was a nightmare.
Oh no, what happened?
They were consistently late on rent, and then they started damaging the property. Lisa spent more time and money trying to evict them than she had planned for.
Yikes. That's a real lesson in patience and due diligence, huh?
For sure. If you don't take the time to screen properly, you could end up with someone who costs you more in the long run, both emotionally and financially.
What about cash flow? I feel like some investors really overlook that.
Oh, definitely. It's so easy to get caught up in the excitement of a new property and forget to really analyze the cash flow. I know a guy, let's call him Dave, who bought a property thinking it would bring in a solid monthly income.
But then
he didn't factor in the local market fluctuations. The rent he was expecting didn't materialize because he bought at the peak of the market, and then, guess what? His cash flow dipped.
that's frustrating. So how can investors avoid that pitfall?
One way is to do thorough market research. Look at trends over time. Don't just rely on what's happening now. And consider having a buffer in your cash flow projections for those leaner months.
Smart advice. And what about timing the market? I know a lot of people who get caught up in trying to predict the perfect moment to buy.
Yeah, the perfect time often leads to missed opportunities. I once had a friend who waited for what he thought was the ideal moment to invest. He kept saying, "I'll wait until prices drop," but they just kept going up.
So he missed out?
He did. He finally jumped in when prices were at an all-time high, and then he had to deal with negative cash flow because the rental income couldn't keep up with his mortgage payments.
That's a tough lesson learned, isn't it?
It is, and it's a good reminder that trying to time the market is risky. It's often better to focus on the fundamentals of the property itself: location, condition, and cash flow potential.
Speaking of fundamentals, what about hidden costs? Those can really sneak up on investors, can't they?
Absolutely. There are always those unexpected expenses that pop up. I worked with a couple who bought a property and didn't consider things like property taxes, insurance increases, or even HOA fees.
Oh yeah, those can add up quickly.
Right? They ended up with a property that was draining their finances because they hadn't budgeted for those ongoing costs.
So how can investors spot those red flags early?
Well, it's crucial to do your homework. Look at past expenses for similar properties, talk to other investors, and don't shy away from asking tough questions during inspections.
That makes a lot of sense. Getting a clear picture before diving in can save a lot of headaches later.
Exactly. And if you do find yourself in a tight spot, it's important to have a plan. Whether it's setting aside reserves for emergencies or being prepared to pivot your investment strategy.
So it's about being proactive instead of reactive, right?
Yes, and keeping an eye on your financial health is key. If you notice red flags, address them early before they become bigger issues.
Great advice, Mike. I think a lot of listeners will find this really helpful, especially when it comes to avoiding those common pitfalls.
Absolutely. There's always a learning curve in real estate investing, but with the right knowledge, you can navigate those challenges and build long-term wealth.
And that's what it's all about, isn't it? Making informed decisions and staying adaptable.
Definitely. So as we wrap up this conversation, I encourage everyone to take a moment to reflect on their own strategies and check for any areas they can improve upon.
That sounds like a solid plan. Let's make sure we're all on the right track as we move forward in our investing journey.
All right. So let's dive into some immediate steps you can take to start leveraging DSCR loans, right?
Yeah, absolutely. It's all about taking action. So what's the first thing folks can do?
Well, first off, if you haven't already, start by getting familiar with your local real estate market. You can use apps like Zillow or Realtor.com to browse properties. Just get a feel for pricing and what's available in your area.
Right, and I think it's important to look at properties that fit within your budget and your investment strategy.
Exactly. And once you've scoped out some properties, you can use tools like Rentometer to check rental prices in that area. This is crucial for understanding potential cash flow, which is what DSCR loans are all about.
That makes sense. So after looking at rentals, what's next?
Next, I'd suggest diving into some calculators. The BiggerPockets calculator is fantastic. It helps you analyze deals and see if a property meets your cash flow criteria based on the rental income.
I've heard a lot of good things about that calculator. It really breaks things down, doesn't it?
Yeah, it does. And if you're looking for something a bit simpler, Deal Check is another great option. It's user-friendly and offers a straightforward way to analyze potential investments.
Awesome. So tools are definitely a big part of this. What about books or resources to check out?
Absolutely, there are some great books out there. The book on rental property investing by Brandon Turner is a solid choice. It really steps you through the entire process of investing in rental properties.
That's a classic. And what about podcasts? Any recommendations?
For sure. I'd recommend listening to the BiggerPockets podcast. They have so many real stories from investors, and it can be really motivating to hear how others have navigated their journeys.
That's a great way to learn while you're on the go.
Exactly. Now, let's talk about habits. Starting small is key. I'd suggest making it a goal to analyze at least one deal per week. It doesn't have to be overwhelming. Just one deal, and you'll start to build a rhythm.
That's super manageable. And what about networking?
Great point. Joining a local real estate investing meetup can be invaluable. You'll meet other investors, share experiences, and maybe even find a mentor who can guide you through your first few deals.
I love that idea. Connecting with others can make such a difference.
It really can. And speaking of networking, leveraging social media platforms like Facebook or LinkedIn to connect with real estate groups can open up even more opportunities.
That's a fantastic way to expand your circle.
And don't forget about local MLS access. If you can get access to your local multiple listing service, it'll give you a deeper insight into property listings and market trends in your area.
Exactly. That's a goldmine of information.
Right? So, as you're gathering these tools and resources, remember to stay committed. Consistency is key. Even if you start small, it all adds up over time.
Absolutely. Just start where you are and build from there.
And don't hesitate to reach out for guidance or mentorship. The real estate community is generally very supportive.
So true. With all these steps and tools, listeners can really start making strides in their investing journey.
So those are some practical first steps. Now let's bring this all together. So as we wrap up today's episode, I think it's important to highlight a few key takeaways from our discussion on DSCR loans.
Absolutely, Mike. First off, the fact that these loans don't require income verification can be a game changer for many investors. It really opens the door for those who might have other income sources or are self-employed.
Right. And then there's the flexibility with qualifying. It allows investors to focus on the property's cash flow rather than their personal financial situation. That's a huge advantage.
Yeah, and we also touched on how DSCR loans can help in building a scalable portfolio. It's about leveraging those assets to grow your wealth over time, isn't it?
Exactly. And don't forget about the importance of understanding your local market. Knowing where to invest can make all the difference in maximizing your returns.
Well said, Mike. You know, building wealth through real estate isn't just about the numbers. It's about creating opportunities for yourself and your family. It's a journey, and every step you take counts.
And for those of you listening, if you found value in today's episode, we'd love to hear from you. Like, subscribe, and drop a comment with your biggest takeaway or any questions you might have.
Yes! And if you know someone over 40 who's interested in investing in property, share this episode with them. It could really help them start their journey.
And next time, we'll dive into portfolio loans versus conventional mortgages. It's going to be an enlightening discussion, especially for those looking to expand their financing options.
So make sure to tune in for that. Thank you all for joining us today. We appreciate your time and can't wait to see you next time.
Take care, everyone.
Bye for now.